So, Sonali, we haven't seen really much market reaction to what Moody's published on Friday after markets closed. But does this have an implication for big banks in particular, if not necessarily immediately for financial markets?
Listen, this has definitely been a very slow-moving train wreck, hasn't it, Kaylee? And if you think about it, another downgrade, what would it mean? Of course, they moved the outlook to stable, but another downgrade would be coming on top of other rating agencies that have made similar moves. And it's underpinned by a risk here of just the larger U.S. fiscal situation, which you guys have been talking about. So what does it mean for banks and asset managers? First of all, the initial reaction on Friday was movement in the futures market. A lot of asset managers really buy or short treasuries through the futures market because of the margin required. And remember, the volatility of the asset class would mean that there is more margin required to be posted for the futures contracts in particular. And then in the context of the basis trade, where you have a lot of asset managers who are buying the spot and shorting the futures and looking to really profit off the difference as they converge and lever that trade up yet again with more treasuries and leverage from repo markets, all of this could just make that process more expensive and create risks of whipsawing what is currently a massive trade and being used by levered funds like hedge funds to be buying treasuries up front. So when you're seeing these supply issues hitting the market, when you're watching new treasury issuance, problems like this exacerbate problems like that. And you're seeing the cyclical issue come to the surface at a time when you have many traders really worried that next year would get worse, not just because of these downgrades, but because of these exacerbated fiscal situation you're seeing for the United States, as well as this other big idea here that bank balance sheets are shrinking and facing more regulation.
I mean, what you're talking about, Sonali, it's specifically hitting the U.S. Treasury market. When you look at the reaction of other asset classes, I mean, equities apparently didn't get the memo that something could be up. So what are the wider ripple effects that could come as a result of this?
Now, you have to think about it. There's two things here. We're talking about margin being required to be held against the Treasury trades in particular. The idea that not only is it going to get expensive because of future regulation potentially coming down the pipe, but also this idea that if you're in a country and you're an issuer in a country, you cannot be rated more highly than the country itself. The one worry that there is underpinning the markets here, besides the Treasury market, is to what degree this will start to impact other borrowers, from investment grade to even riskier borrowers, at a time, Danny, where we're seeing more fallen angels. We're seeing more companies fall into junk territory and more companies also facing bankruptcy at the dire end of the spectrum. And so we've seen a wave of issuance kind of front run a lot of economic data into the last couple of weeks. But when you see problems like this compounding, you have to wonder if it will really stop the party on Wall Street and make issuance much more difficult at a time where refinancing is already coming at much, much higher rates.
Yeah, it's really interesting to think about from where I sit here in Washington, Sonali, as if we avert a government shutdown, but it doesn't come with steep spending cuts, if that actually ends up being the worst case scenario for Wall Street, then potentially a shutdown in which conservatives are able to extract some deep spending cuts in order to bring it down. So it kind of is a question of like, what outcome does the market really want here?
Totally. And, you know, tomorrow, for example, we're going to spend about an hour with Ken Griffin, founder of Citadel. And they're one of the big levered funds that I've been talking about that has been engaging in the basis trade. One thing I'm going to ask him about is how much more capacity can they really take on in Treasury markets, particularly with this dynamic. We've seen massive fund managers to the likes of Stan Druckenmiller really come down on even the Treasury Department for not managing the rising financing costs better. Is there something to be learned from this experience that should create a difference in how we finance the United States moving forward?